Good morning, everyone, and welcome to the Vickery Holman Property Market Update, our spring version of this. Of course, I was so pleased that after COVID, we were able to do in-person ones in the early autumn. And welcome to join us here today. We had so many of you who wish to hear what we have to say 6 months after the last session, and some changes since that time, of course. So a little bit about Vickery Holman. Across the Southwest, we have our 4 offices. My name is Mark Pellow, Managing Director of Vickery Holman, and we are the largest firm of property consultants across the Southwest. Offices in Treloar, Plymouth, Exeter, and Bristol. From each of these offices, we carry out our various services, including valuation, agency, building surveying, property management, landlord and tenant rating, and various other expert works, including dispute resolution, etc., right across the region. So we hope that you'll be able to make use of our expertise across the area. We are employee-owned with a heavy investment in our staff and well-being and leadership and training, which has all been contributory to our significant growth in size over the last few years. So what I am going to be doing is handing over any minute to Alan Treloar, the director responsible for agency, who has been very busy in a time that is both challenging and also opportunities across the region for our clients. So I'm going to invite Alan to join me now to talk about the regional property market in this update.
Hi, Mark. Yeah, thanks very much. So thanks, everyone.
So you've been a busy person, is what I would say.
Yeah. I think the last, whether we look back 6 months to our last in-person market review or the last 12 months since the last online one, it's been very, very interesting times, that's for sure. But we keep on going and keep on working really hard for everybody and building on what we've got, really. So good morning, everyone, and thanks, as Mark said, for joining us today for this market update. We're going to run this a bit like the last online one we did of these about 12 months ago, as on a sort of conversational basis and with Q&A, with us looking at the main property sectors that we deal with across the Southwest as busy commercial agents. Before I go any further, do pop in questions and respond to polls that might appear on the side of the screen, and we'll either pick them up as we go if we think we can, or we'll mop them up at the end. And of course, if anything's too detailed or we just don't get there, we will respond as soon as we can after the event, because we'll be recording all those questions. As Mark says, I'm a director here at Vickery Holman, and my day-to-day work is basically sales and lettings of all sorts of properties across Cornwall and occasionally further afield. So to set the scene before talking to my various colleagues, I'd just like to give a quick overview of where I'm seeing things. The last one of these online reviews last spring, we were just coming to terms with the initial shock of the Russian invasion of Ukraine and the very, very early warning signs of inflation and interest rate rises, but no talk of the extreme headwinds that have unfolded since. And not only the levels of inflation and interest rates have reached, of course, we're waiting for another interest rate announcement today, but also the extreme cost of utilities that all businesses have been facing, which are very much at the front of all our minds at the moment. And last April, again, when we were doing this online presentation, we were still coming out of COVID, the COVID period, but with a fairly straightforward sense, I think, of where the market was heading. But since then, things have become a little bit more complex, for sure. Talking about the core sort of 3 sectors, industrial, offices and retail. The industrial sector has continued to perform really well. Deals might be taking a little bit longer to get over the line and perhaps a bit fewer and further between, but the relative scarcity of available space and the sheer strength of most businesses which occupy industrial types of property means that rents remain strong and prices, where any freeholds do crop up, are also very, very strong. Offices are still a mixed picture, and though we're pretty much 3 years to the day since the first lockdown, I think all of us office occupiers are still coming to terms with our office requirements, and we're still to see more change as that sort of works its way through the system. Certainly, most of us continue to value the office as the best place to work for many, but so many staff have now learned to be just as productive with much less time in the office that it doesn't look like that hybrid model is going to be going away. The investment sector has been in a certain amount of limbo as bank interest rates have increasingly put yields under pressure on the primest of stock. but the yields on more secondary stocks seem to have been more protected in our experience, and there's still many investors looking to find a property investment in the southwest to put their cash into. Land, whether commercial or residential, remains in relatively short supply across the region. Developers and owner-occupiers are continuing to continue to look out those land opportunities. It's probably fair to say that most are being a bit more cautious and deliberate in their approach, and we'll be particularly talking about the residential sector a bit later. The leisure sector is the last one we're going to come to, and this has seen very significant challenges in recent months, leading to what has felt to me like a bit of stagnation either side of Christmas, but there does recently seem to be some return of a little bit of optimism amongst operators, and it looks like we're going to see some deals on the leisure side of things in the run-up to the season. So without much further ado, and you will have to forgive me if I chop and change a little bit. I'm not the most skilled presenter, so we've got a lot to get through. So if we do dive from one subject to another without much aplomb, then that's what that's all about. So to set things off, I'd just like to invite Joe High and Zach Maiden to the stage. Joe heads up our general commercial agency activities and works mainly out of Plymouth and East Cornwall. And Zach runs our agency activities in Exeter. And with those two, we're going to run through a little bit more detail of the core commercial sectors. So welcome, Joe. Welcome, Zach. Good morning to you.
Good morning, Alan.
I think the plan was to look at the industrial sector, first of all, despite a running order I did run right here for myself, which I got the wrong way up. So the industrial sector, I suppose a very simple question to kick things off is just how's that side of things performing? I've already said I think it's doing well. What do you guys think?
Yeah, it is much the same as what you said, really. Demand's still strong, lack of supply, especially in Plymouth. We haven't seen as much new build stock as you guys have up in Exeter. So that gap is still there. So still very good.
Is that the case? Is that more new product up there?
There is now actually more product coming to the market, but we're still seeing demand extremely strong. We're about to complete the last deal at Sky Park, hopefully in the next coming days, and then there'll be no more availability there. Then you've got obviously the next phase of Mercury Business Park and potentially the next new site at Barnstable, which is going to be another 35 units. So actually more supply is coming, but they're being snapped up relatively quickly.
Yeah, I get that sense that even if there's a bit more churn maybe in the market, with a few units coming back, there seems to be people lining up to take them just as rapidly as ever. Is that right?
Yeah, that is true. However, people are being a bit more selective on what they go for now. So with the cost of living crisis, etc., obviously with the cost of gas, electricity, etc., people are being a bit more cautious. But having said that, we're still putting things under offer. So I think there's a little bit of caution there, but it's still lack of supply right now in the industrial market.
Yeah, so it's kind of leveling off of. We're not seeing that steep increase that we've seen, are we? We're just leveling off at those higher levels. Maybe with a little bit of rent free sneaking in there, but not much, because as you say, there's if you need something, you haven't got much to choose from.
I agree with that, actually, Joe. The thing is, we were seeing stuff that we're quoting whatever rents, and we were seeming to get them. So the next deal that came along was even 50p more on per square foot. Mm-hmm. But now I think in the last 3 months, it's leveled out. So it's actually quite good because you know where the consistency is now, and you know where those values are. So yeah, absolutely, Joe.
Yeah. So rentals have sort of become settled at a new norm, if you like, really, at whatever point they're at, because we have seen very significant rental growth, haven't we, over these last 3 years or so, which is bucking the toughness of other parts of the economy, if you like, maybe. And the new things that are coming out of the ground, that's still happening quite obviously, so it must be viable for people to build, despite the increase in costs and so on, which have been part of life over the last couple of years as well.
Yeah, still, probably more so in Exeter than Plymouth, but I don't think that's a viability thing. I think that's just a lack of land and space to do it. And I think build costs, mm-hmm. I'm sure Tim will touch on this a bit later, but they are starting to slow down a little bit in their increase. There is a bit more consistency there. So certainly a few clients I'm talking to that maybe haven't started building and have been considering it, and now thinking, okay, now's the time to get back on track. So we've got a bit more consistency. We can rely on supply a little bit more.
Yeah, the new build that we've been dealing with down here in Cornwall, it might have been not quite flying like it was 12 or 18 months ago or so, but it's continued to let well and achieve rents that we want it to achieve. That's for sure. Flipping around to another sector, offices. As we say, 3 years today, pretty much since the first lockdown. So a big, whole seismic change for sort of offices and what people want from offices over the last 3 years. What's the demand like now? Are we seeing across your parts of the region?
We've seen actually demand improve a little bit, but it is all about quality. And I've said this a few times, but there's probably, we're quite lucky in Exeter in a way. I'm careful how I say the word lucky, but we have a lack of supply, and we have done now for the last 5 years. We need quality, and the buildings that have the potential to be refurbished will be getting, and actually are producing record rents now. But there are some buildings in our city that likely will never be let again, and then, it's the alternative use that is creeping in. But that, of course, is going to put even more pressure on supply. So I can actually see a bit of a resurgence in offices, and I'd like to add on that it's all about retaining staff and all about recruiting as well. So the best staff, if you want them to come into the office, and I've just been noticing the poll as well about how many people are actually coming in. It's very healthy to see that a lot of people on this call, we're all talking about getting our staff back into the offices. Now, for that matter, we need the best accommodation, and for that matter, there's going to be a resurgence, I feel, in the office sector.
Yeah, because picking up on your point that you've not got enough stock anyway, because you lost a lot lots of years ago now, I suppose, to alternative uses already, didn't you? Turning to residential in one form or another. So we have seen the supply chipped away anyway, and some of that was quite good office stock. But at the time, for whatever reason, the market wasn't there for it, let's say 10, 15 years ago, I suppose now, and we've lost that stock. So, and I think that idea of the quality, it was talked about almost immediately, wasn't it, when there was beginnings of a return to an office sort of more nationally and in the big cities and so on. It was all about that investment in the quality, but that is rubbing off down here as well now, as you say, I think.
The problem we've seen in Exeter, and I'm sure Joe will talk about Plymouth in a second, we don't have a lot of quality stock in the city centre. So there's been a lot of deals out of town, which has pushed rents up out of town. But of course, we'll probably talk about the retail sector and leisure sector in a minute. But of course, the more people that go out of town, it's going to affect our in-town retail and leisure market, and this is something we want to obviously push on. And well, it's hurting us quite a bit in Exeter at the moment because of just lack of availability.
Yeah.
Exeter seems to be the most flying of our sort of locations, doesn't it, Joe? Probably.
Yeah.
Is that fair to say?
I think so. I think Plymouth isn't quite so rosy on the office front, but then it never has been. So I think our demand is probably back at pre-COVID levels, maybe a little bit better. Similar in terms of it's all about quality. So some of the big companies in Plymouth are moving around now, and they are taking space that is good quality for that very all the reasons Zach just said about getting people back into the office. And rents wise, I think actually we probably have seen a bit of an increase over the last kind of couple of years in town and out of town. Not massive increases, but we've edged up a bit, and now we're kind of coasting along that slightly higher than pre-COVID level.
One thing we haven't quite touched on, another trend though, I suppose, is serviced offices becoming more of a little bit more flexibility for people and so on. That was a thing that was beginning to grow before COVID, then probably shut down a bit whilst we couldn't go out and so on, but has had a resurgence, I guess. And some people now, because of the fact that it's still slightly coming out in the wash really what office requirements are going to look like, I guess that makes serviced offices a good, well, if I was a landlord, I suppose, a good use of my office building potentially, if it could be converted to serve that purpose.
Yeah, definitely.
You guys got any thoughts about the serviced office market?
Yeah, well, Plymouth, I think last time we were on a call, we were talking about Block down at Royal William Yard and them opening up. They've since opened, and I think they are pretty much fully fully subscribed down there now, which kind of says it all about the demand. I think their product is good quality. They have other offerings such as a gym on site, a cafe, events. So I think that's where that market is going. I think it will. We're kind of catching up from the London, Manchester, etc. It's filtering down here now.
Yeah. And you've seen some of that in Exeter as well, Zach, I imagine.
Yeah, absolutely. I think we mentioned this last time we had the market update. Yes, absolutely. During COVID and over the pandemic, and businesses weren't sure what exactly to do with their office accommodation. So they were going into flexible space simply to have something, a satellite office, or some flexibility in what they do for the future, whether they need a larger space or a smaller space. But I think what we're seeing now, and the feedback I'm getting, is that people are actually going, well, I think we've trialed it. It works to an extent, and it does work. It's proven that. But I think people now want that consistency of, well, we now know what we want to do, what we need, and the hybrid working model is still in play. So we want a permanent office now, and that is what we are seeing. So there's always going to be a place for serviced offices, but I just don't think it's going to be as sharp as it rose over the pandemic for obvious reasons. But there's no doubt flexibility is still on the mind of office occupiers.
Yeah.
And when we're talking about putting a break in at year 3, which obviously if you're going to refurbish an office building to a very high grade B plus or grade A standard, developers need that certainty of at least 5 years. So they couldn't give that with people who are looking at the flexibility. So there is still a place for serviced offices.
Yeah.
It's a matter of people, well, what we're seeing now is people are making decisions, which is good news for our local economy.
Flipping to retail, retail been in lots of change for lots of years, really, hasn't it? Since the invention of the internet, probably. But because of that, retail has had to rebase itself quite a bit over, well, perhaps many more years than perhaps offices and so on, hasn't it? So I think, personally speaking, down here in Cornwall, there seem to be people looking for those retail opportunities, whether they're looking to rent them or looking to opportunistically buy something. How are you guys finding the retail demand across your parts of the region?
It's still pretty. Yeah, sorry, I'll go first. Still,
okay, ladies first.
Still pretty good actually, and I think we, before Christmas, the whole strikes with postal strikes did everyone a little bit of a favour in terms of if you bricks and mortar store, because people came back into the high streets and they went and did their Christmas shopping in person. We saw footfall in Plymouth up, kind of something like 30% year on year. We have to be a little bit careful about, because we're comparing a slightly COVID year to a normal year, but regardless, that's still pretty good. Retailers are still reporting that people are coming in and spending money, and as you say, we've got the demand. People are looking for the right thing at those rebased rents, and with the rateable values having been slashed in the new list coming forward, that's helpful as well.
Yeah, we'll pick up on the rating with Jordan in a little bit, one of our other colleagues. But Zach, same for you really on the retail front. You've been doing some deals, haven't you? And
yeah, we have actually, and we could have a whole discussion about this in a separate video, to be honest. But I think retail actually, in my patch in particular, coastal affluent towns and Exeter is still very strong. Obviously, probably people might be bored of me talking about it now, but actually, as long as it's affordable, relatively small, and in a good location, in good position, sounds like a few words in there, but there is actually opportunity and there's demand for it, and they're going relatively quickly. We just had the high street unit on the market, which you might have just seen, 43 to 45 Exeter High Street, and that let within. It's a prime retail unit, and it let within 3 months of being on the market to Brook Taverner, a very good quality regional independent business, gentlemen's clothing. And I think actually that's where the opportunities are. It's less so about the big national generic brands, and it's more about independents or regional players who want to upgrade their premises and get into a better position, but also providing a customer experience and brand awareness. I think what we saw over COVID was people were still buying. A lot of assets went up in value. It was a different way of dealing with things. A lot of it was over the internet, but as long as we're in tune with how buyers and consumers are actually transacting at the moment, Some retailers are doing really well out of this and interacting with people on online social media and forums, etc. And I think that's the key thing. It's about knowing your customer, and I think that's where retail is there's opportunity.
Yeah, people who are getting it right are still getting it right, aren't they? Occupier-wise, they're driving the footfall, in a more modern sort of way, and got a blend of online, actual bricks and mortar, and everything else. And there's still some success out there, isn't there? And obviously it's all about occupiers, but we haven't got time now to touch on the sort of the free buying, the freehold acquisition side of retail. But there is a lot of opportunities in retail, isn't there? As long as we don't hang all of our hats on the ground floor rental sort of thing, if we know it's a blend of ground floor rental, which needs to be appropriate level and getting some value out the upper parts as well, which again is another video probably. We touched there briefly on the impact of the rating revaluation, and retail in particular has seen a bit of a coming down of rateable values. So I'd quite like to move on to Jordan Kennedy, if that's okay with you guys. We'll
Absolutely
invite Jordan onto the stage. Jordan heads up our rating department, our rating consultancy here at Vickery Holman, and she's been very busy over the last few months, as we have had a new business rateable value coming in very, very shortly now. So morning, Jordan. Thanks for joining us. Thanks. Hello. We've mentioned retail. Retail, you can tell us RVs have come down. What about other sectors? Explain to us a little about the new list and what's happening.
Yeah, thank you. Yeah, quite right. Retail values have come down as we expected, which is very good news. I've seen some huge reductions and some not quite so large, but overall in the southwest, they've come down by just under 5%. So that is good news. Other occupiers, not quite so lucky. So we've seen, well, we will be seeing as of the 1st of April, so just a couple of weeks' time now, industrial values going up by 27% on average, offices 14% on average, and there's a category called other, which takes in all sorts of property types, but that's an average of 5.9%. So within that, it's a bit of a mixed bag. Holiday parks and caravan parks, for example, have gone up by 32%, car showrooms 23%, and restaurants 17%. But on the other hand, you've had self-catering holiday units going down by around 12% and pubs going down by around 4%. So as I say, yeah, a real mixed bag across the southwest, and there are winners and losers, as I think there is at every revaluation.
So a slight surprise that offices went up a little bit, perhaps. Yeah,
that was surprising. We were certainly predicting that they would stay a bit more level than that when we've had previous discussions on this topic.
Has there been any changes in reliefs and multipliers and that sort of thing that also come into the picture? Or?
Yes, well, so the multipliers, I'm glad to say, have stayed the same. So that's 49.9p in the pound for rateable values under 51,000 and 51.2p in the pound for those above 51,000. And that's throughout 2024. So a little bit of stability in that respect. The retail, hospitality and leisure relief, which is currently at 50%, is increasing to 75% from the 1st of April. So again, that's good news for a very wide range of occupiers that fall within that category. Transitional relief is in existence again at the revaluation. So those that are seeing an increase in their rateable values will see them phased in. And those that are seeing a decrease will enjoy the benefit of that straight away, which hasn't happened in previous lists.
Okay. And so just tell us, new list comes in beginning of April, so no time at all to check your old RV, hardly now. But
not really.
What's the process ahead of us now?
We've had
thinking about this big outgoing. There are business rates, one of the biggest outgoings. So yeah, tell us what we can do.
Yeah, so well, I suppose there is a couple of days still to check the old list. If people did want to, as long as they have a check in the 3-stage system on the government gateway before the 31st of March, there would be time to think about challenging the value. So it's not all is not lost at this point. But other than that, moving on to the next list, from the 1st of April, you can submit a check and a challenge via the government gateway. So a check is factual errors such as floor areas, air conditioning, plant and machinery. And a challenge is a look at the actual rate per square metre that VOA have used in the valuation. So rateable value should reflect the rental value of the property at the 1st of April 2021. So if that looks really out, that's a good place to start with thinking about challenging that valuation.
Okay, and I guess just conscious of pressing on to our next topic, but thank you. I guess the underlying thing is anybody, whether it's themselves or clients or anybody else who's have suddenly realised that rates are an extremely large outgoing that they've got and just want to have a chat about it. That's something we're always open for, isn't it?
Absolutely.
And I think we do regard ourselves as pretty strong in the rating side of things down here in the southwest, particularly to have a physical presence in every office and so on, which is probably quite unusual, I think, on business rates. But obviously, it's such a key topic and such a big thing for lots of people. So yeah, we obviously always encourage people to come and talk to us about business rates.
Very much so, and I think as we have such a lot of access to transactional information, thanks to our agents and our valuers, we're really well placed to advise on values as well.
Yeah, we certainly know what it should be. Yeah. Thanks, John. That's excellent. Thanks very much.
Thank you.
Moving on without any delay, I'd just like to bring Claire Cochran onto the stage now. Claire specialises in investment property across the southwest for us. There's Claire. Morning, Claire.
Hi.
So Claire, with her sort of regional approach and looking at different sectors, is really well placed to talk to us about the investment market and what's going on and what's moving and what's a bit more sticky right now. So Claire, I think you were the one predicting most of the economic challenges more than the rest of us 12 months ago. You had a bit of a keen eye to what might be down the line for us, and of course most of that happened. So how's things been over this past few months in the investment market?
In short, interesting. Following some rather significant challenges at the end of last year, which were amplified by the fallout from the mini budget, we did see many people say, right, I'm just going to watch and wait, see what's going to happen, which ultimately reduced in transactional volumes went down quite significantly to below 5-year averages on a national level. Repricing nationally was quite fast, with yields moving out across the board, really, and it was much more rapid than during the financial crisis. But there was massive variation in location and sectors. And actually, thankfully, down here, as you mentioned earlier, it's been relatively shielded in comparison to some locations. And looking to this year, we've had brighter economic forecasts in general, and sentiment is increasing. And actually, there is good demand for most asset classes, what we're seeing, what is going on in the market. Yesterday, clearly, inflation having gone up to 10.4%, which wasn't anticipated. So people are going to ask questions over how that projection of it falling below 3%, how realistic is it? And I think it's really going to see how much of that was driven by adverse weather conditions and food supply chain shortages, and how much of it isn't. The labour market remains tight, which is good. And interest rates, well, we're going to see what the Bank of England says in a few hours' time as to where they're going to go. Prior to this Credit Suisse debacle this week and inflation announcements yesterday, most people were then expecting it to peak at 4.25% this year, instead of 4.5, 4.75 that was previously thin. So I think, challenges are clearly going to remain this year, but with that comes opportunities. And overall, we just think it will improve as the year goes on in terms of investment.
And I suppose what's been moved, what's continued to keep moving then, sort of sales wise, and what's looking hottest over this forthcoming period then?
So industrial sector clearly been very, very strong for quite a few years, and nationally, where prime stock nationally, we haven't ever seen it down here, but if it's 3.25%, it clearly that yield had to shift out quite a lot to account for changes in the market. So it was quite a sharp repricing. Locally, though, as my colleagues have said, demand remains strong. The overall supply occupation is quite low, so that's given investors confidence. So we've seen good levels of interest in stuff that's come on the market this year. There was some price chipping in quarter four last year, but not to the degree that I think we've seen other places.
No.
And actually, one of the changes, that we've seen is just that the profile of investors has changed. So it's, lots under 2 million are more shielded than the larger lots because less funds are buying. And we're seeing and talking to more high net worth individuals and family propcos that want to invest down here. And I think COVID's done us a favour with that, actually. It's sort of put the Southwest more on the map as connected.
Yeah. And those people generally, probably Zach or Joe was talking earlier about quality and that sort of thing. I guess people are attracted by quality, both of just the sheer bricks and mortar, but also more environmental matters are more and more important to people, which tends to be more modern stock, doesn't it, in a lot of cases?
Yeah, absolutely. That is coming up the agenda. I mean, you've got the MEES legislation, which changes, if it's got to be a C by 2027 for an EPC or a B by 2030, that's at the forefront of everyone's minds now. And it's something we're being increasingly asked, what is the EPC? Has anybody looked at how it can be enhanced?
Yeah.
Which, even 18 months ago just wasn't even factoring on them.
No. And I think just on the positive side of that, I think the EPC assessors changed their algorithm slightly last year, was it? And so we are seeing things that actually are being reassessed now. Actually, we had a shop done a day or two ago, and it was a B, which was surprisingly good, I would perhaps say. So I think it's not all doom and gloom on the EPC front, is it? Even I think it's just a case of tackling it and not just sort of putting it to one side for as long as you can. It's a subject worth digging into, really, isn't it? And so much so important, particularly on the sales front. Okay, Claire, thank you. I think in the spirit of trying to keep moving on through everybody and have a bit of time at the end for some questions, which we very well might bring you back in on. I'd like to say thanks very much, Claire, for the minute, and bring in Tim West, development surveyor. Thanks, Claire.
Morning, everyone.
Hi there, Tim. Good to see you. Thank you. So Tim's a development surveyor working for us sort of primarily in the more east of the region, but with an overview of the whole southwest, I'm sure. Good morning, Tim. Thanks again. Obviously, again, going back certainly 12 months, maybe not 6, but it's been a lot of changes in what seemed like otherwise a market was just rising and rising and rising. What's your sort of reflections over the last few months in the development market?
I think, you do have to look at it it is a struggle at the minute to look back on the past 2 years and draw any meaningful conclusions that we can really go forward with. I think most of the statistics we see are referring back to a 2019, the more normal market, and then the past 2 years, which have been unusual to say the least. It is good news. I think I spoke 6 months ago, just after the mini budget, and there was a huge degree of uncertainty in the market. The residential market particularly was seen as being very much propped up by the impact of buying trends caused by the pandemic. And we certainly saw it dip quite sharply following that mini budget. But I think the data shows that it's recovered very well. And we're actually not far behind the level of sales activity at this stage in 2019. And we're not far below the levels of average asking price seen in that period as well. So I think the message is that it is a return to a more normal market and stability. The last 2 years weren't sustainable.
No, you look back to 2019 as being the last sort of sensible year, possibly, maybe.
Yeah, that's normality in terms of what we're trying to level our expectations at. But the positive news is all the areas I'm seeing, activity is still positive. I think, weirdly, it's the first time buyer section of the market that's really improving the best at the moment. I think that's partly due to the big massive houses at the top end of the market are being slightly overpriced. We're seeing those prices the asking prices being pushed along the rest of the sectors of the market. And that's probably why there's a bit of a dip in terms of the sales agreed at that level. It's some interesting data I saw on the number of sales being agreed 50 kilometres outside a person's original address. Which is sort of this link to the pandemic trends that people want to move very far away and change areas. That has reduced quite sharply in the past 4 or 6 months. So that's an interesting dynamic.
So habits are getting a bit more back to normal as well, perhaps a little bit. Yeah, some things.
I think so. And like we were saying before, employers and employees are sort of settling back to maybe not exactly how things were, but a bit more normality. And now it's, I met quite a lot of people over the pandemic who moved to Bristol and were still working in London. But I don't think employers are entirely happy with you applying for a job and living in Cornwall, say, but still getting a London wage. So these things are all going to balance out.
Yeah.
But very positively, the housing market is still strong, and I think will continue. I think we're going to see a stability in prices, but slow, stable price growth as opposed to the frenetic price growth. And also with a more normal market, it will encourage a lot of buyers who didn't want to get into the sort of bum fight for the mad rush for the limited amount of properties that were on the market. I think it will encourage a lot more people to actually say, look, we've got the time and space to actually do this properly now.
Yeah, to look again, or look because they kept their heads down. Yeah, I understand what you mean. Yeah, so there isn't really a sort of a decline in that market, in the resi market ahead of us, really. Then it's an adjustment and a back to some kind of normality is what you're sort of seeing, and also what you're predicting, really.
Yeah, for sure. Obviously, it's good that we're going to need to see how things go with inflation and the wider economy this year. But interestingly, mortgage rates have fallen back from their peak last year. So an average rate for a 15% 5-year fixed mortgage is now 4.65%. That's down from last month's 4.75%, and October's quite unfriendly 5.89%. So if you compare it to this time last year, that was 2.48%. We are moving in the right direction, but I think we've still got headwinds, and it's still going to be a difficult period. But I think it's really reassuring for the market, for the economy in general, and the wider development market, that we've got this relative stability.
We haven't got a lot of time to talk about it at all, really, and it's probably another subject in itself. But build costs, and so on, we're all aware of how they've risen astronomically in the recent past. Is there any sort of positive outlooks on build costs at all?
Again, I think those are stabilised. There are some materials that were seen as being cheap before or expensive before. I think we've seen a lot of things shoot up and then settle back down to a level. If we'd had the rising build costs and a decimated housing market, we'd have been in a fair bit of trouble, I think. But I think the marrying of the two together, I think it has absorbed a lot of the damage that could have caused. That's not to say that I'm not re-looking at the viability of some schemes, and that there are issues for some types of builds. But generally, it's not cut activity. I'm still seeing, at the start of the year, we've seen a real recovery of activity in terms of these early stages of development, people getting funding in place and getting moving on site. And I'm seeing people really wanting to press the button after taking a bit of a hiatus at the end of last year and going, are we going to do anything next year?
You've got to start. You've got to have that pipeline, haven't you? You can't just shut up shop completely, because you'll be stuck with no product in 9 months.
But I think if things had gone as badly as we thought they might have done, at the end of September, I don't think that we'd be seeing much activity. But I think we've waited and seen. Whatever your thoughts on the current administration, we have had a more stable economic outlook recently. And I think it's uncertainty. Business hates uncertainty, rather. We might know we're not going to a particularly. It's not the top of the market. We're not in a particularly rising market, but at least we know where we're going, and we can have some confidence in making commercial decisions.
Yeah, thanks, Tim. That's really great, Tim. Thanks very much. We might come back to you depending on what questions we've got a little later on, but thanks very much indeed for that insight, Tim. Thank you very much. Right, again, without much further ado, the leisure market. Mike Easton operates across the southwest for us on the leisure side of things. So we can bring Mike onto the stage. Good morning, Mike.
Good morning.
So, Mike, what's happening in your sector?
What's happening in my sector? I think we're coming out of a little bit of stagnation, really. There was a lot of negativity heading into the last quarter of last year, mostly driven by the press with cost of living. I think most of the operators were sort of preparing for the worst, whereas actually on the ground the operators had a pretty good time of it. I think despite what the media's portraying, people are still out eating and drinking. The impact for my market, though, of course, is that the buyers, all they're hearing is cost of living crisis, lots of challenges in the sector. So they've all sort of sat on their hands for the last, coming up 6 months now. Yet on the ground, as I say, actually, trading businesses are doing quite well. So it's starting to come back. The leasehold market sort of kicked off reasonably well at the start of this year, and we're starting to see the freehold buyers come back, having probably just waited for deals, but deals that aren't necessarily coming. So yeah, there's a bit more activity. That's for sure.
And what's the outlook for that for the next sort of 6 months, I suppose? Are people going to just hunker down and do business again, or do you think they're getting to a stage in either life or their business life cycle or whatever where there will be more stuff coming onto the market?
Yeah, life cycle's the thing, funnily enough. I think we'll see a bit more stock coming to the market now. I think we'll see some probably longer term operators committing to the market. There were a few that wanted to do it last year that then held back as things started to get tighter, because we did go through some pretty good times actually during COVID for disposals. That came to, like I say, a reasonably abrupt stop. But I think that will come back. I think there'll be a few over the next quarter. I think we'll see a lot more established businesses coming for sale themselves, having an eye to be out at the end of the season, the back end of this year. That's pretty much where the timing goes.
Are you getting, what sort of vibes are you getting for the just a simple holiday season ahead? But late bookings and that sort of stuff has become more of a thing again, hasn't it? As people have had more choice of places to go and so on. Have we got any?
Yeah, I mean, we jumped back to sort of later bookings. That was probably the case pre-COVID. What we're hearing at the minute, I mean, we've got Easter around the corner. Bookings have been very good.
Okay.
Interestingly, bookings have been very good, or particularly good at the higher end pricing.
Right.
So people have got money to spend, and they're just prepared to spend it down here. I think on the food and beverage side, the established operators, they're doing very well anyway. I think by and large, operationally, people are quite confident for the year ahead. And I think for buying and selling, we've got a few processes going on at the minute. We've had interest. We've got 2 that have closed where we're going to make a decision on both of them. We've got 3 underway, and we know that we'll get buyers through the door. So things are actually looking up.
Well, that's good. Good. We talked about business rates with Jordan and others earlier on, and relief for hospitality businesses and so on is sounding pretty generous to me. Is there any other things that are coming out of that? I suppose it's government support almost, isn't it? From the rating side of things.
I mean, there's no two ways about it. Business rates have been very favourable to the hospitality sector. It's really needed. You've got to remember that they've got increased employment costs. They've got increased costs for the food that they need to buy in to sell out, and of course they've got increased energy costs. And there's been a little bit of help there, but not a lot. So rates, there certainly has been help. We've got, well, starting from April, we've got a 75% discount across the board. So that's another year of help. Broadly, the hospitality sector has done quite well with reductions in rates, particularly in pubs. Some of the restaurants, but mostly the high street ones, that's sort of not quite so good as you were getting out of town, which is trying to rebalance getting people into town. The hotels, I think, have been hit particularly hard, and the self-catering guys seem to have got the benefit, which seems a little odd because you've got hoteliers that are far bigger employers than you'll probably get across the board for the self-catering units.
Sector.
It sort of feels that's the wrong way round.
Okay. Excellent. Thanks, Mike. In my, without further ado, moving on sort of theme that we've been having here. Thanks very much, Mike, for the minute. We'll see if we'll bring you back on stage shortly for any questions or anything else that's cropped up. What I'd like to do now is just have a look back at the polls which we've been running to see how those are faring, what sort of responses we're getting there. And working habits prevalent in your office or company. I think we had a mixed set of answers there, but I think a lot of people saying they're mostly back in the office. There's a lot of mixed, most days in the office. There's a big response there. And very few, only 6% of our respondents have said they're basically based from home. So it bears out what the other guys were saying, and I don't really need to bring them back to the stage to say this, I suppose, that there's obviously a really clear place for the office. The office is still with us as a place to do business. And moving on from that, we asked a question about trialling a 4-day week, which there's 91% of people said they've got no plans to do that. So there's a few that are interested in it. There's 3 that may have moved to it, which is interesting in itself. But the vast majority are still hitting things on a more traditional approach, which is interesting as well. Interest rates, got a spread here of people. Will they go up, down, or stay as they are? Well, I guess, we are possibly expecting this small increase today, aren't we? So probably the go up, the 45% who reckon the interest rates will go up might have that. Got a handful. 18% of people think that rates might go down in 2023, which we've still got a lot of the year ahead of us. So it's going to be really interesting to see what happens with that, and a few no ideas as well. And looking at Mike's leisure side of things, we've got a question about what are plans for holidays in 2023. So we've got 70% of respondents think they'll be taking 2 breaks, which often those breaks can be, at least one of them might be local, or at least in the UK. So that probably bears out to some degree what Mike was saying about the outlook for this season ahead being fairly positive. So that's good to see that people aren't just hunkering down and watching what they're doing too much. So let's turn to the chat a minute and see if there's stuff in there to let's try to bring some other people back on the stage a minute. Let's have a look. We've got probably one for Jo. She'll know. She might be able to see this anyway. We've got some talk about Plymouth here, Jo, around empty retail space, and there being quite a lot of it still in Plymouth. And now we've got the tree debacle sort of going on. What can we say about Plymouth city centre at the minute, Jo?
Yeah, so I kind of alluded to a little bit in the chat. I think, yes, there probably is a bit of there is an oversupply. Like a lot of city centres, it's a bit too big. So that's kind of one thing. The other thing, actually, but all the stuff we're marketing, other than the Debenhams, actually is kind of under offer or
something happening.
Yeah. So we don't really have anything sitting there that is doing nothing. The Debenhams is kind of a different kettle of fish, because the planning application is in for conversion of the uppers, so it is quite a big ask for an occupier to take that on, knowing there's probably a couple of years of it being knocked around quite a bit during the the build works, but we still got interest in that. And it's the upper parts really a lot. I think probably what people are referring to is the kind of blank space at the top of New George Street, where there's kind of a line of quite a few empty ones, which opposite the Debenhams doesn't look great, but that's the whole building. People don't want those upper floors, so and that's what we've been doing on Cornwall Street. We've been letting just the ground floors, and we've got up to quite decent zone A's of sort of £45-50. So yeah.
Okay, and I see you've answered a little bit some of that stuff in the chat side of things as well. Thanks, Jo. Just stick around for a minute, just in case there's anything else we can talk about. There was a question there about will the RVs that talk about rateable values and different sort of splits of different sectors be something we can mail out? I'm sure we've got that, so we can do that for somebody who's asked that question. There's a question about industrial supply, again in Plymouth actually. Industrial development in the pipeline in Plymouth, is there any? What is in the pipeline? And is a lack of supply due to a lack of land available or a lack of appetite? I guess appetite amongst developers, I suppose. I suppose you've got some things which maybe have stalled some development in Plymouth.
We've got Langage Energy Park, but that is part of the Freeport. So that's not as straightforward as we've got some land, let's put some industrial units on it. That's got a gateway policy, so you have to be in certain sectors which are marine, technology, defence, or within the supply chain for that sector. So that's not really open market space. So there isn't really anything else coming forward at the minute. We've just finished, or nearly just finished, Barrack Court. The council have been building them up at Plymouth International, so that's kind of four industrial units and then a load of offices. But that that's not going to soak up all of the supply that we've got in Plymouth, and that's a bit more. It's not out and out industrial. That's kind of quasi office business space as well.
Okay.
So definitely not a lack of appetite. Probably, if you were going to say anything, it's a lack of land to
deliver on.
Really.
Yeah. We've got a technical question here that do hang around, Joe. I think we've got room for half a dozen people on the stage, or go if you like, whatever, but I'll have you back. Jordan, the contractors test in relation to rateable values. This is a question that I don't know the answer to. Can you help us here, Jordan? Jordan, come back.
So I was on my way. Where is that? What does it say? Sorry,
has there been a significant increase in rateable values subject to the contractors test?
I'm afraid I do not understand that question.
Okay. Well, we'll pick it up later.
Okay. I'll have a think. Yeah,
that person might drop a bit more in there as well. Anyway,
yeah,
okay. Not to worry. It was interesting what Mike was saying about rateable values and the treatment of business rates for hospitality businesses and so on. That was picking up on that. So good to.
Yeah, I was surprised as well that self-catering has gone down.
Okay.
So much when that was self-catering holiday accommodation was certainly very popular and still is, but very much so during the pertinent years, 2020, 2021.
Okay.
I think that's interesting, as Mike said.
Yeah. Okay, John. Thank you very much. Okay. I don't know whether Zach wants to join us for a minute just to talk about these working habits and offices and people still coming back and not really drifting off to a 4-day week or anything like that. I think that just bears out, Zach, what we've been talking about office demand still being there, really, just in a slightly different way for some people, maybe.
Yeah, I think so. I remember this question being brought up last year, actually, and I think a lot of people were uncertain. But it seems to me that how can we fit enough in the 4-day working week when we've been proven to work effectively from home anyway? However, I still what we're seeing is people are looking at refurbishing their offices and putting quality into their working environment in order to get people back in. And as I said, we've proven we can work flexibly. So I think people are just saying, well, you can come in and out as you please, but please come and join us because we are, a progressive, interesting firm. And this is a
good place to be. Yeah.
Place to be, and it's about loyalty as well, attracting loyalty into a business.
We've had a question about serviced offices and have any actually sold, have any serviced office investments sold in the Southwest recently, and what yields might they achieve? I don't know if any have. In my experience, I don't know. It's a thing that people have been sort of taking an office property which perhaps needed some investment, turning it into service space, and then wanting to work through that new sort of way forward for a particular property that I've seen anyway. And
it might be one for Claire to jump in on, but there was Broadwalk House, which was bought 80,000 square foot in Exeter, bought by Castleforge, and they converted ground and first floor into serviced offices as part of their.
But bought a big unit to do that with, rather than sell the completed trading going concern serviced office space or entity, I guess. So maybe that's something that hasn't really quite emerged yet, perhaps. Is it in terms of?
No, I think it was about 125 pounds a square foot. I think overall the investment sale.
We've got a question here about an insight on how strong the fitness and leisure market is in Exeter at the moment. Are you all into fitness and leisure in Exeter?
Again, that comes down again to quality of offices and having bike racks and showers and all the extra amenities that go with offices now. And if you look at what's going on at Winsley Park, there is a lifestyle choice there. There's beautiful grounds to walk through. There's a gym on site. There's healthy eating on site. There's collaborative working. There's service offices as well as traditional offices as well. Yeah, absolutely. And it also comes into ESG and how people use their offices at the moment. I would say health and fitness, and again, to bring people back into the office is a big factor.
We've got an EPC question here. EPC on commercial units, who's liable, tenants or landlords, and how will old Victorian shops, for instance, ever meet the proposed requirements?
Yeah, that's a good question, isn't it? I saw a statistic that said 83% of the retail stock in the UK doesn't fit the B or above the 2030. So yeah, I think that's a whole. You could almost do a whole webinar on it, couldn't you? But
sorry, Joe, go on. Sorry.
No, carry on. Go on.
I do apologise. I didn't mean to. I thought you'd finished then. I have seen quite recently people sneaking in clauses in leases where landlords have to put the property back to level E standard at the end of when they leave.
Landlords or tenants?
Tenants.
Yeah.
Interesting.
I think it's, and then what we haven't seen yet is this real testing of the listed building status and the viability.
Exemptions and
the
stuff,
landlord proving that it needs to be exempt for whatever reason because of cost effectiveness of works to bring it up to standard in a listed building and that sort of stuff. We just haven't scratched the surface of that yet, have we?
No. And
also,
actually, sorry, Carl.
The only thing I was going to say, I did get this B on an older shop very recently. So it's an interesting thing. It's an interesting thing. It's tricky, isn't it? I think the legislation actually hasn't gone past white paper stage yet. So technically, it's not legally binding. So there are some out there who are not even abiding by it yet. That's it's not our advice, and I think the majority of the market are acting as if it is legislation. But we're if we're agreeing leases now for that are going to go over 2030, which they probably are, what do you that is an argument that hasn't been settled, because if a tenant's fit out actually makes it less than what it needs to be, how do you in practicality take out their fit out, improve it and put it back in at that date? Is not actually isn't workable in real life, is it? So, no, there's still a lot of water going to the bridge there, isn't there? To say, I mean, what we are talking about more often these days is taking a more strategic approach to it rather than simply instructing an assessor to go and give us a rating and tell us when it's done, sort of thing. It's a bit more of a collaborative thing than that simple approach nowadays, I think, in a lot of cases. We've got one here, perhaps the last question of the day, maybe, because we're knocking on for 11 o'clock. We've got a question about pedestrianisation in some Cornish towns. How do we think this will affect in-town commercial units? That's a good question too, but people can have different opinions on whether you think it's good to have cars mixing with pedestrians or not in town centres. And we know how popular drive through. I mean, that's stretching a point from a town centre, but people like their cars and they like to just drive up to things and just do their biz and go home again, don't they? So things which make towns less car friendly but more pedestrian friendly is a real difficult one to get the right answer to, probably, isn't it? And one which is going to come down to the will of the public, I suppose, as much as anything within any particular town. But people really want convenience, don't they? I mean, we didn't touch on it in our presentation, but the whole drive-through, drive-to market on the outskirts of towns is pretty hot at the moment, isn't it?
Yeah, definitely. Yeah, I think you can fall, as you say, probably 50-50 if you were to poll it, but people do want their convenience, don't they? So yeah, it
is a 50-50 thing, isn't it? You've got those who want their convenience and those who want the lifestyle and the pleasantness of a nice place to walk around and do their biz. So the only thing is with town centres, I guess we've seen that rebasing of rents that we've talked about already, that retail space just isn't particularly expensive anymore, is it, by comparison to perhaps what it was once upon a time? So maybe that is the only thing which will help keep town centres' vitality, whether cars or no cars. There are a lot cheaper places to operate a business from now than they ever were. Right, everyone, if that's okay, we're about done and we're really heading on to 11 o'clock now. So thanks everybody for staying with us for an hour, or the best part thereof. So without much more ado, we'll let everybody get on their way. I'd just like to thank everybody for attending today. It's been really good to see how many have stayed with us and interacted with us. And if you've got anything you want to come back to us about to follow up, then obviously we're very happy to hear from people. I'd like to say thanks to everybody who's taken part today from our side of things and people who've made sure it's happened. And we were all here at more or less 10 o'clock to get on with it. So that's really great. Thanks everybody behind the scenes. And of course, thanks everybody for attending one more time, clients and referrers and everybody else. Thank you very much indeed. And we look forward to keeping on doing business with you as the year progresses. Thanks everybody, 59 minutes and a few seconds. Thanks very much indeed. Have a great day.